Hey, I'm Pazi D with the Pazi Group Real Estate Advisors, and thanks for checking out our video blog. Today we're talking about credit, so stay tuned. Hey again, I'm Pazi D with the Pazi Group Real Estate Advisors here at Keller Williams Realty, and today we've got a special guest. I've got Matt Garcia in the office with us today. Matt is with Supreme Lending. He's just a phenomenal loan officer. He's been ranked consistently, so over the past 3 years within his company, he's been the #1 loan officer across the country. And in the state of Georgia, he's been ranked #1 in sales volume. So it's a real pleasure and honor that we have Matt in the office with us today. So we want to ask Matt some questions, just talk to him about some credit, answer some of you guys' questions. So this one specifically is going out to Rachel. We just got off the phone probably 20-30 minutes ago where we were talking about home buying, and she had some questions around credit. We talked Credit Karma, we talked about different FICO scores and stuff like that. So I wanted to shoot this video and bring it to you so that you can benefit from the question that Rachel asked. So Matt, pleasure to have you on with us today. Thanks for joining us.
Thanks so much, Paul. You appreciate the opportunity.
Absolutely, absolutely. So Matt, talk to the people. Tell us about the difference between a credit score that you might get at Credit Karma or just online or what have you, that credit score versus the credit score that you get when you pull.
Great, happy to do that. So when it comes to looking at your credit, what most people don't realize is that there are 9 different versions of the FICO model out there. So whenever you get your credit pulled by yourself as a consumer, you do your freecreditreport.com, Credit Karma, you see it on your credit score, say, hey, here's your FICO score, this is what lenders use. Well, what they're using is a version called FICO 8. FICO 8 was a consumer-driven model that was created as more marketing. It's designed mainly for smaller credit card use, mainly designed for very limited type of credit profile review. So it actually doesn't give a lot of weight to negative history, any past problems, credit collections, things like that would ever come into play. So it's designed to artificially give you a much higher score. And the design for that is that when people see a higher credit score, they're happier, tend to spend more money. So that's a very beautiful marketing scheme that was actually created and done, and no one bothers telling anybody that, hey, no one really uses FICO 8. It's just simply there as a model for just a few small items and not the big ticket items. Now we refer to big ticket items when it comes to a mortgage. The model we use for FICO is called FICO 2, FICO 4, FICO 5. It's a very different model. It assesses credit risk in a long-term factor, and that's why it's a much more conservative model. So oftentimes when we get people that apply with us and we pull their credit score and we'll ask them, hey, have you looked at your credit in a while? I was like, oh yeah, my score is around a 720. It's really good. And then we go to pull it, that score ends up around a 660 or 650. It's not because the inquiry caused any impact, it's because the credit model is completely different in terms of how it assesses the credit. And that's one of the most common things we do have to address is that, and it's not that they're having bad credit, it's just simply assessing more of the other items that happen in their longer history, and that's why the credit score range gets a lot more impacted for our model.
Got you. Thanks for that.
You got it.
So tell me, Matt, the FICO model that you see out there for the consumers, you said that's a FICO 8,
Mm-hmm.
right? All right, how big of a difference or discrepancy do you tend to find from that credit score and what you will pull?
So it depends upon the history of their credit. So if there's been any kind of credit history where you had any missed late payments, or let's say you ever had a collection or two in the mix, oftentimes you can see that credit difference between 30 to 40 points differential. But if you ever had any kind of major derogatory credit, the most common things we see are often with student loans, that something kind of came out of deferment and didn't realize that there were late payments there and they hit across the board. A couple collections, there's ever been any kind of bankruptcy or any kind of lien history against you, then there's a massive difference, anywhere between about 100 points or more that you're going to see, because those are major derogatory risks that review on that, and that's why FICO 2, 4, and 5 hit you harder. Oftentimes, perfect example, we had a gentleman that a couple months back had applied and he was at 800 credit score. Everything was perfect, had very limited trade line, but he didn't need much. Well, we went to re-update his credit because now he's back in the mix to buy new properties, way to update that credit model. Well, all of a sudden he had a small medical collection for about $35 from a doctor visit that had popped up recently. that 800 credit score dropped down to a 650 just like that. So it's a very critical thing that when you are applying for a mortgage and you're looking at your scores, if you're in good pristine condition, one, to always make sure you monitor everything going on every day. And the most common thing is to, especially if you've been to the doctor, to make sure those bills are paid, because whether it's $25 or $25,000, on the model of FICO 2, 4, and 5, it doesn't matter the balance size. It only matters that it's negative, and that's where the score becomes impacted.
Gotcha. Are there any other just big questions that you get, like every single time that you do a loan application, or just questions that you get on a regular basis from home buyers?
Absolutely. The most common thing we get is this going to harm my credit? Because that's the most, no one's ever taught credit out there. No one's taught in schools. There's not a class saying, hey, this is how it works. It's pretty much one of the best kept secrets out there about how the model actually affects each individual. So when you hear about people say, well, if I apply for credit, it doesn't harm my credit. It does, depending upon the model that's being used. So for example, going back to FICO 8, like we talked about, FICO 8 is designed not to like an inquiry, whether it's a good inquiry, like a secured mortgage or a secured car note, or a bad inquiry, like a unsecured loan, like a credit card or revolving trade line. Any of those type of trade lines or any inquiries on FICO 8 impact the score. So when we go to pull the credit report, someone said, well, my FICO score fell, I got notified under FICO 8, which is fine. We don't use FICO 8, but under FICO 2, 4, and 5, it recognizes the fact that you're looking for what's called secured financing, which is a house. Same thing with car notes. So any inquiry during a 45-day period only counts as one. So that's the one thing about when we go to pull the credit score for FICO 2, 4, and 5, the inquiry is not going to impact anybody. It's going to be okay. But if there have been a lot of inquiries where they've applied for credit cards or relevant trade lines, those will impact the scores. But for 45 days, that consumer has full range to pull their credit, and the same thing is going to be seen over and over again with whoever lender pulls it. Same thing for car financing. And if you go apply for a car loan and the auto dealer says, hey, well, let me show you what we can do, you would see your credit score pulled like 10 times in one day. But again, those 10 inquiries only count as one. So that's one of the most common things we try to bridge the gap with consumers, that, hey, look, this is not going to harm, this is why. And let me explain the differences of FICO's of model of credit that we're reviewing, and it often puts them at a lot more ease for that.
Got you. And so just so I'm understanding this correctly, and that everybody out there is understanding this correctly, you're saying that if you're applying for a mortgage, you'll have 45 days where you can shop different lenders, sure, you can get your credit pulled, and it won't impact you.
Exactly, will not impact you. Nope. Now, one thing we do tell folks to keep in mind is that your credit is a living, breathing instrument. So it's always changing throughout the month. So your credit scores all of a sudden just report at one specific time. Each trade line you carry reports at different times in the month. So you could have 2 student loans that report at the beginning of the month. You could have a credit card that reports in the middle of the month, another credit card that's at the end of the month. So as people are pulling the credit, if sometimes there is a difference between what's being pulled, it's because some part of your profile and your credit has changed. And so that doesn't mean the inquiry impacted you, it's something that's different, has changed on a balance or an updated amount, and that's what's causing the change and the slight differential.
Gotcha. Cool. Well, that's good information. I think people will really be able to take advantage of that and use it in their arsenal. So if you got any questions about real estate, about mortgage, about anything real estate related, don't hesitate. Shoot us an email. You can reach me at pazi@pazirealestate.com. Again, that's pazi@pazirealestate.com. Look, if you have any questions, don't hesitate. We're here for you. God bless you, and we look forward to helping you. Take care.
Take care.